Welcome back, traders. Today we are diving into the latest commitment of traders report, specifically looking at the US dollar index, and more importantly, what the positioning data is telling us about potential market direction going forward. So that's what we are going to look at today. We're not just going to look at the numbers. We are reading the positioning of smart money versus retail, how the imbalance often gives us early clues before price makes its next major move, right? So for those of you who are not in the mentorship group, we've got what we call the COT report, and this is a report that comes out every Friday, I think roughly about 9:30 in the evening towards market close, and it tells us a lot of information in regards to the non-commercials and the commercial players in the industry. So I'm not going to go into deep in regards to explaining what it is. There is videos on the channel which you can watch at your own free time. So I'm going to walk you through the key changes in positioning, what's been happening since the start of the year, and how this aligns with the broader macro narrative that we are currently trading in. So we're basically looking at the period from January up until May 2026. Right, so this report here, I've been capturing my report since I think 2021, if I'm not mistaken. Let's just see. Yeah, April 2021. So 2021, 22, 23, 24, 25, 22, 23, 24, 25, 26. So I've been capturing this report for the past 5 years now. Never miss a week. Yes, I never missed any week in regards to the data, because it's very important in my analysis. So, but today we're only going to focus on the data from January up until the current release, which came out last week on Friday. All right. So make sure you watch this closely, because this is where sentiment meets structure. Price tells us what the market is doing today, but positioning tells us what the institutions are preparing for tomorrow. So let's dive in. Right. Understanding the players in a summary. Before we analyze the data, it's important to understand who we are tracking. The group that I focus on most is the non-commercial traders, right? These are the hedge funds, asset managers, large speculators, and institutional traders. These particular participants are typically responsible for driving trends. The second group is the commercial traders. These are corporations and large hedges who often take the opposite side of speculative traders, right? They take the opposite side of speculative traders, the ones that we refer to as the non-commercials. When both groups are positioned in opposite direction, valuable insights can emerge, right? So from the report, I have divided it into phases, right? So phase 1, which is the January to early March, institutions were bearish from January to early March. So we are talking of this data here, right? This data that I've highlighted up until the 3rd. Institutions were bearish on dollar, right? Looking at the first quarter of the year, institutional traders maintained a bearish stance on dollar throughout January and February. non-commercial traders remain net short. They remained net short right here, negative. They remained net short up until end of February. The most bearish reading occurred during the week ending March 10. So we're looking at this reading here that we got 10 March 2026, where we had negative 5,882 contracts on the non-commercial side. Remember, these are the guys that drive the trend. This tells us that hedge funds and speculative money were actively betting against dollar strength, right? At that stage, the broader institutional view favored a weaker dollar environment. Take note, a weaker dollar environment. I'm not saying dollar is bearish or dollar is weak. It's the environment that supports a bearish dollar. For traders, that would naturally support bullish Euro USD, bullish gold, bullish commodity currencies, and then bearish DXY. The market was clearly positioned for dollar weakness. That's phase one, the January to early March. And then phase two, that's mid-March up until end of April. This is the phase two in the classification. And this here, I refer to this as the major regime change, right? Now this is where things get very interesting. Between mid-March and end of April, the data that I've highlighted, we witnessed a complete shift in institutional sentiment. Non-commercial positioning moved from approximately negative 5,000. We are right here on our net position, moved from 5,882 negative right here to a positive 5,511 contracts. That's from mid-March until the end of April. You see, until the end of April. That's a swing of more than 11,000 contracts. This wasn't random noise. Take note. You must understand this when you read the chart. Remember, you just don't capture this number for the sake of capturing. You should be in a position to read what the number is telling you. This was institutional money changing its view on the dollar. During this period, shorts were aggressively covered. New long positions were added. Speculators became increasingly bullish on DXY. Just a quick one. Let's take a glance on DXY from mid-March. You see, right here. You see how much was bullish? How much was bullish? And then April, we had a redistribution again into fair value. And then you can see May and June, they're quite bullish, but they haven't really gone anywhere that much. So this was the strongest bullish dollar positioning environment of the year. We're talking about this period here, right? Remember, this is a monthly chart, right? So we've got January here, down close candle, February bullish, March bullish, right? So that was the strongest bullish dollar positioning environment of the year. The COT data confirmed that institutions were actively supporting dollar strength. For traders, maintaining a bullish dollar bias during this period would have been supported by the positioning data, right? For traders. The commercial positioning was sending a message. The smart money divergence, right? While speculative traders were becoming increasingly bullish, commercial traders were doing the opposite. when you look at the net position of the commercial traders, you can see the beginning of mid-March all the way up until the current reading. They are negative. They've got negative net positions. So as hedge funds bought dollar, commercials became increasingly short. This divergence is important. Commercial traders are often willing to sell into speculative enthusiasm, which is currently what's happening right now. Now, this doesn't mean the dollar must immediately reverse, but it does suggest that the trade is becoming crowded. Whenever a trade becomes crowded, traders should begin evaluating whether the reward still justifies the risk, right? Is it still ideal for me to continue being bullish on dollar? Is it ideal for me to be bearish on dollar? You see, you have to evaluate your positioning. Now, this was the first warning sign that the bullish dollar trend was becoming mature. The moment we started seeing the net position of the commercials turning negative, right? Then phase 3, which is now May 2026. I refer to this phase as bullish conviction begins to fade, right? Moving into May, right? So we're talking of this data here. Moving into May, we start seeing a very different picture. The strong bullish conviction that dominated March and April began to disappear. Instead of institutions adding to dollar longs, positioning started becoming inconsistent. Net positioning dropped significantly from its April highs and moved back towards neutral territory. You can clearly see April, we had a high and then market turned bearish for the whole month of April. The latest reading, right, sits around positive 850 contracts right there. That's for the non-commercials. We are sitting at 850 positive contracts. This is a major change from the aggressive bullish positioning we saw just weeks earlier. Week of 12 May, week of April 28, and so on, right? The message from institutions is simple. They are no longer aggressively buying dollars, but they are not aggressively selling dollars either. They are waiting, right? And when institutions are waiting, it usually means they are looking for a catalyst. We're not going to go into detail in regards to catalysts. We've already covered that in the detailed analysis of DXY. We all know what that catalyst is going to be, right? Another thing to take note of in the May phase, right, which is the phase 3, is open interest, right? There's more participants, but less conviction, right? One of the most interesting developments in May was the increase in open interest, right? So in May, we started right here, 28 April, then we got 32,000, then we got 40,000, we got 42,000. Open interest rose sharply, indicating that more market participants are entering the DXY market. However, despite this increase in participation, directional positioning remained relatively balanced. This tells us something important. The market is attracting attention. DXY is attracting attention, but the participants have not yet agreed on the direction. This type of environment often develops before a major move. The market is preparing for something. The only question is what the catalyst will be. Looking at the current institutional reading on DXY, right? The latest non-commercial net positioning is approximately 850 contracts, right? This is the latest as of 26 May 2026. The next report is coming out tomorrow. Yeah, the 5th of June. That's the next report that we are going to get. The one for 26 came out last week on Friday, the 29th, right? I'm not going to go into that detail. We all know the report comes out every Friday, but it's actually released on Tuesday. So based on my framework, right, what I've concluded and what I've analyzed on this COT report for DXY, right? A quick note for those who don't know where to get the report, you can get it at CFTC, Commodity Futures Trading Commission, under Market Data and Economic Analysis. You just come to your Commitment of Traders report, and then you can get whatever report you need from here, whether it's Chicago Mercantile Exchange, the long format or short format. You choose which one you wanna get, right? So for instance here, this is a short format from the Chicago Mercantile Exchange. You can see there we've got the Swiss franc futures only position as of 26 May 2026. We've got the Japanese yen, we've got the euro, we've got the Brazilian real, you've got the NZ dollar, you see, we've got the South African rand and all that. So you can get a report of whatever you are trading. If you look at, say, energy, right, ICE futures, you can go here, you're going to get your energy, things like solar, oil, and the rest. So this is where you get your COT report, right? So back to my analysis based on my framework. So above 5,000 contracts, when we look at the non-commercials, above 5,000 net positions. So we're talking of this column here, folks. Above 5,000, that's a strong bullish USD. Between 2,000 and 5,000 contracts, that's also a bullish USD. Above 5,000, that's a strong bullish USD. Between 2 and 5,000, that's just a bullish USD. Between negative 2,000 contracts and positive 2,000 contracts, that's a neutral USD. Between negative 2,000 contracts and negative 5,000 contracts, that's a bearish USD. Below negative 5,000 contracts, that's a strong bearish USD. So take note of that net position on the non-commercials, right? At positive 850 contracts, which is the current net position, DXY sits firmly within the neutral zone, right? Institutional traders are not expressing strong conviction in either direction, right? What does this mean for us as traders? The biggest takeaway from this year's COT report so far is that the strong bullish dollar positioning that existed during March and April has largely disappeared. Like if we go to the chart, let me open TradingView. You see, March and April we had a very strong bullish dollar that has largely disappeared. Institutional traders are no longer aggressively accumulating dollar. This does not automatically mean DXY must fall, right? However, it does suggest that the institutional support behind dollar strength is much weaker than it was earlier in the year. As traders, we must remain objective. We don't trade opinions. We don't trade opinions. We don't trade emotions. We trade evidence. And right now, the evidence suggests that institutions are waiting for the next major catalyst before committing to a new directional trend. In terms of catalyst, we're talking of Middle East. That's the main catalyst right now on hold in terms of where we are going on dollar index. Yes, we do have the midterms coming in America soon. That could also put pressure on DXY, right? So, in conclusion, my current bias on DXY, right, based solely on the COT data, my current assessment is neutral to slightly bearish, right? The bullish momentum in institutional position has faded significantly. For the dollar to regain a strong bullish bias, we need to see hedge funds beginning building meaningful long exposure once again. So we're talking of contracts above 5,000, right? For us to have a strong conviction that dollar is going to go higher. Until that happens, I remain cautious about chasing dollar strength. Yeah, that's what I've been saying in the group, in the mentorship. Chasing dollar strength at this moment in time, be cautious about it. As always, continue monitoring inflation data, employment reports. We've got one coming in tomorrow. Federal Reserve commentary, geopolitical developments, too much indecisions going on in the Middle East, and global growth expectations. These are the things that you have to keep monitoring. These are the events most likely to provide catalyst institutions are waiting for. So yeah, that wraps up the COT breakdown on dollar index. The key takeaway here is simple, guys. Positioning is shifting, and when we align that with macro flows and technical structure, it gives us a much clearer edge on what could come next for the dollar. As always, don't trade the report in isolation. Use it as context. Combine it with price action, liquidity, and timing. So yeah, if you found value in this breakdown, make sure you like the video, subscribe, and share it with your friends and trading groups. I'll see you in the next one. Stay patient, stay disciplined, and let the market come to you. Thank you for watching, folks.